What if I told you that 95% of traders are looking at the wrong thing? While everyone is chasing fancy indicators and complex strategies, the smart money is simply following two basic forces that move every single market on this earth. So by the end of this video, you'll understand why Bitcoin is now pumping at 120k, why and where markets they crash, and why and where they surge, and most importantly, how to spot these moves before they happen. But here's the catch. Most people, they quit watching these videos after only 2 minutes and never get to the actual strategy. Or they skip through it to get the good stuff and ultimately ends up not understanding jack because they were acting like the market's best friend. Impatient. Don't be one of them or stay broke, it's up to you. Alright, so let me start with something that might hurt your feelings a little bit. If you're using 15 different indicators and drawing trend lines everywhere and still losing money, you're overcomplicating this. The market doesn't care about your RSI or your MACD or your mortgage payments for that sake. It cares about one thing: where buyers and sellers they meet. That's it. Every single price movement in history comes down to supply and demand. Stay with me here because in 3 minutes, I'm going to show you how to spot these institutional footprints on any chart and also give you my 65% win rate with a 1 to 2 risk to reward supply and demand strategy. Have you ever tried ordering an Uber after a concert or doing a rainstorm? Suddenly, this $10 ride becomes a $40 ride. Why? Everyone is trying to get home at the same time. High demand, limited drivers. But catch an Uber at 11 a.m. on a Tuesday is dirt cheap, no one is riding. That's supply and demand. Same car, same app, completely different price. Just like any market. But here's what the textbooks they don't tell you. The markets don't move because of the news. News is just the excuse. No, you see, markets move because of imbalances between supply and demand that we're accumulating for weeks or even months. Okay, so let's quickly draw out what a supply and demand zone is, so we get a fundamental understanding on how they look without candles. Don't worry, we're going deeper into this in just a bit. Okay, so you see the market move up and down and up and down and up, down, and then suddenly we have a big spike up. Now this big move up here happens because there's a lot of demand at this area. A lot of people are buying in. The hedge funds, the institutions, the banks, they find the price very lucrative right here. That is how the market moves up. Only the players in the market have the firepower to move the market like this. Now the demand zone in the big move up is the small move down. And this demand zone we can stretch to the right. So what happens when the market goes back to where there was previously a lot of demand? Well, there is still a lot of demand here and there's still a lot of pending orders staying there in the market. And the reason why there's pending orders is because not all orders get filled because of high frequency bots and because there's not enough liquidity. There's more people buying than selling, and then there will essentially be more buying orders just resting right here. So not enough with there's enough buying orders here. There's also a high demand from the price of this area. So when the price then moves back here, we can expect another move up. It is the exact same with the opposite side. We have some small market movement down, and then we have this big ass push down. That is the banks, the hedge funds, the institutions, the people with a lot of money that is doing a massive sell-off. Now, because of the demand zone, the previous swing up for the big move down is our supply zone. So when the market then comes back up here, there's still a lot of pending orders. There are still the hedge funds, the institutions, the banks, etc. that wants to sell at this price because they found it to be a lucrative place to sell their positions. Therefore, we can expect another move down. Now look at this gold chart. See how price kept getting rejected around this level right here. That is not coincidence, that is supply. Smart money was selling every time that the retail traders pushed price higher. Then when the rebate was lifted and the news came out right here, they blamed the news. But this sell-off right here was already planned. Now we have a little more to cover before we look into my strategy, so hang with me here. You need to be able to understand everything in order to profit from this. So here's how to actually read a chart. Forget everything that you have learned about support or resistance. We're looking for supply and demand zones here. Areas where price moved aggressively away from with high volume. So let's just start here. We're on gold. Gold almost always moves up, and when it goes down, it doesn't go down for very long before it starts moving up again. That's why I love trading up on gold. So let's just break it down. Right here, we have an aggressive move up. We have a break of structure, which shows us that the price is actually moving further up. Then we're having a demand zone being created right here. The last move down before the big move up. Now you can take the whole move or you can take the last candle. The last candle is also a move in itself. I usually take the last candle and I love it when it's an order block. I'll get to that in a second. Now see, because we broke the structure here, we broke it here, and we broke it here. Buyer shows momentum to the upside. What happens when we go down to our demand zone where this essential move started? Well, buyers are stepping in again, and then we're pushing price to the upside. So if you would have bought right here, you could have put your stop right there, and then you could have put your take profit right there at the next high. And then you would have secured a 1 to 1.5. Now we have another aggressive move up right here. Here we have an order block laying right there, which is essentially the last move down before the big move up. We could also just take this one, or we could take these. It doesn't really matter where you put it. There's risk to reward with everything. Now I'm just explaining how this works. So what happens when the price moved down towards this demand zone? We didn't quite hit the demand zone. The buyers already stepped in here and then pushed price to the side, but you get the idea. Then we move on. Over here, we have another aggressive move up right there. We have a demand zone being formed right here, which is the last move down before the move up. Could be all three candles, could be these two candles, could be this candle. You decide. Risk to reward with everything. You get a better return down here. You get a higher chance of an entry up here with a lower return. Now, what happened when price moved down to this demand? Well, buyer stepped in, pushed price to the upside. Right here on the smaller time frame with two small candles, we have a demand zone as well. Every time the market pushes up rapidly, a demand zone is being created. Now, the demand zone is this candle right here. That is the last push before we went up. Now, what happened when we went down here? Well, buyer stepped in again, and then we pushed up. Now, what happened here? The price moved up aggressively. Previous move down before the move up was right here. What happened when we came around this demand zone? Well, the buyer stepped in and pushed price to the upside. Same thing happened here. We have a demand zone here. We have an aggressive push up. What happened when we got down here? We got up again. What happened when we tapped into the demand zone where the initial move started? We shot to the top. Same thing with supply zones. We have a initial aggressive move down right here. The last swing up was this swing right there. What happened when we got into the swing? Well, we started pushing down again. Supply got filled. And we have the exact same thing with the example before here. The market pushed price down. The last candle down before the big aggressive move is right there. What happened when we got up to this point? Supply got filled, pushed the market down. We got up again, supply got filled, pushed the price down another time. Same thing happened right here. Aggressive push down. Last candle before the push. We got up and then we got pushed down again. Now, all of this tells us that institutions are selling at these levels right here and buying at these. Keep in mind, don't do demand zones in a downtrend. Don't do supply zones in an uptrend. Follow the trend. That is where you'll get the best results. Now look at Bitcoin in 2023, price kept returning to this $25,000 level. Every time we hit it back in 2022, we went down, then we went up, hit it again, went down, then we punched through it, got back to the level. Institutions came in. This is now demand. Price pushes up, comes back down, price pushes aggressively up, comes back down, price pushes aggressively up. Now normal retail don't have the firepower to move something as big as Bitcoin like this. This right here is institutional demand. Now you might ask, why were they all buying at 25,000? Because 25,000 is clean, it's simple, and it feels right. It's like telling your friend you're raising up a solid 10 on Instagram. You're not telling him that when you zoom in, she's actually a 6.2. You see, institutions don't care about the exact bottom. Now, they care about stacking size at levels that look good on a report and doesn't make the CFO's eye twitch because he has to read decimals. 25K straight out isn't magical, it's just attractive. It's a psychological level. It's what we call a key level. It's like symmetry in a face or abs in a mirror. We like symmetry, we like clean stuff, we like stuff that's not complicated, and most important of all in trading, we like round numbers. So when the price finally broke the 30K level, it wasn't because of some indicator crossover. No, it was because the supply got exhausted. You see, institutions sold here, institutions sold here. Now there's no one left selling in the market, and then demand overtook supply and just skyrocketed big. But here's the part that separates profitable traders from everyone else, which is timing. Now I'm about to show you exactly when you can enter these trades. And I'll also give you two simple strategies that you can test and apply for yourself. Alright, so here's the strategy. I call it the supply and big D strategy. I'm just kidding, it has a boring name. I call it Supply Demand Pro. And you know what? It, I'll rename it. Supply and big D strategy sounds a little bit better. Alright, so the demand zone has to be created. We have to have a break of the earlier structure. And keep in mind, this is on gold. I only trade gold. Supply zone has to be created. It has to be sufficient enough for the risk to reward, and it has to look clean enough. And then we have to have a break of the earlier structure. Let's take it to the chart. Now, this strategy is stupid simple, which is why it works. So this is on the 1 hour time frame on gold. Step 1, find areas where price moved aggressively away. 2, look for a break of the earlier structure. We get that right there. Step 4, find the previous move down, preferably the previous candle down. That is your demand zone. Put the trade. Stop loss below the demand zone, give it a little wiggle room, top and bottom, and drag your take profit. Let's just go over 1 to 2 here. Now you have to wait. You wait for the return. Boom. We slapped into the demand zone and then we rose straight away and then we punched into our take profit. And there we go. There we punched into our take profit. Now, while you were waiting for this trade, another trade actually emerged right here. Previous candle down, initial move up, demand zone pushes up. We have a break of structure as well. We enter the trade right there and we hit what would be a 1 to 2 like we did before, like that. Put it to 1 to 2, just like that. Beautiful. All right, what now? Well, we have another push up. We have another break of structure. We have another sufficient demand zone right there. Previous candle down. Now look, this is the previous candle down. So what I like to do if there's another candle that is wicking below that previous candle is I like to give the market a little more wiggle room, a little more protection. So is this sufficient enough? We'll zoom a little bit out, play, you wait, we enter, boom. Market moves, and boom, take profit. There you go. Now what happened here? We get a break of structure. We get a previous candle, previous move down, 2 candles right there. Get an initial move. Price moves back into the demand zone, shoots up again. Now that was just a couple quick trades for you guys right there. You can either enter right away or you can look for a rejection or a liquidity rejection. This is entering right away. That is what I do myself. Let's take another example where we look for a rejection before we enter. Now for this trade, we have the break of structure right here. We have one demand zone right here and we have another one right here. I'm going to choose to go with the middle demand zone. I love these middle demand zones. It is usually just a way for the market to grab some liquidity right here and then shoot to the upside, like literally shoot. So what we need to wait for here, this is another way to enter and I'm going to show you both of them in this one because I know this move, I took this move, I got tapped out on this move and then I actually entered in again after the liquidity grab and then well I made 25 bands on this and I'll show you in a second. Now let me just show you how you can wait for a confirmation, and this works very well on all the other pairs, and it also recently works very well on gold. So we have the move up, we have the demand zone. Now we have to wait for the price to go back in and we have to wait for a rejection. All right, cool. So we get the rejection right here, but we don't enter right away. We want to wait for another confirmation. So we move down to the 5-minute time frame after this rejection. Right here we actually have a break of structure, but I don't think this is sufficient enough. So when you're on the 5-minute time frame, I would go for another break of structure to really show the market is creating some buying momentum to the upside. By what? By creating a trend like this, and then we want to enter here. So let's just roll out and see what happens here in a second. We're not getting a sufficient break of structure yet. We just keep moving down, a little bit up, and then we're moving down there. There we go. All right, let's go back to the 1 hour and show you how you can enter now. Now, if we look to the left right, this is where the liquidity rests. This is the previous low for the swing up. This is the low of the demand zone right there. Now, what the market is doing here is actually creating a liquidity grab, and I got tapped out on this trade, and then I entered again. So now we have a liquidity grab right here. What do we want to wait for? Now again, we want to wait for the market to create some momentum to the upside through a trend on the lower time frame to get an extra confidence that we're actually going up after this liquidity grab right here. So once again, we're going down to the 5-minute time frame. And what do we want to see after this liquidity grab? Well, we want to see this structure being broken because this is the most obvious structure. This is the most obvious recent high. So we're just waiting right here. Let's just see what the market is doing. Speed it up. The market came up, we rejected from the zone. We're rejecting again, going down a little bit. Now, bear in mind, the market actually created a higher low right here, and we're pushing to this upside. And right here, we can actually draw a trend line here, which shows the buyers are gaining momentum in the market. So we could potentially place a trade right here with the stop below this stop, and then take profit at however high you want, and then wait for it to play out. Or you can wait for the market to break previous structure. There we go. We have a break. We're still moving a little bit. And there we go. Now we have a sufficient break. Now you could take this demand zone right here on the 5-minute because supply and demand is essentially the same on all time frames. The only difference there is the higher the time frame, the stronger the structure. So we could take this like that. We could already be in a trade like this. We could wait for the market to go down to that demand zone right there. And there we are. We're in the trade. And then what is happening here? We're just slowly moving to the upside. Speed this up. Look at that. Beautiful. Beautiful. Now that is how you can utilize it. You can wait for the liquidity grab, you can wait for the rejection in the demand zone, and then wait for the market to form some structure to the upside. Now we see right here, we formed some structure, we tapped into the structure, and then now let's take this box and put a little bit up like that. Let's remove this trade that we entered earlier that we got a pretty good return on. Let's remove this trade. Now, when we finally broke through all of this resistance right here, that is when the market started to surge. And then we actually had our demand zone here, which is this order block, this previous candle down, and then when we give the market a little bit of wiggle room, we actually entered right away, right there, and we could have entered right there as well. And then the market shut up. Then you could have traded supply and demand on the way up here as well. Take that demand zone, we have the initial move up. We're in the 5 minute now. We push down into this demand zone right here through this candle, and then we shut up. See if we push down into this demand zone again. No, we don't. But we push down into this demand zone right there, etc., etc. You get the idea. Now, the reason why this worked is because we combined the 1 hour time frame with our demand zone, and then we followed the trend. So we see that the market broke the earlier structure, started creating some structure to the upside, demand zone right here, liquidity grab right here, and then we just started moving up from there. And if we zoom out and we look at gold on a bigger scale, we're in an uptrend as well. We're going up. We're always going up on gold. Now, these examples are very good ways to do it. Now, you have to find the pairs where there is a higher probability of this happening. Now, let me give you some sauce. When you do it with the buy limit and you enter right away on the demand zone, that works very, very well on gold. But only when you know the market movements and when to do it. You have to be able to follow the trends properly. And recently, the one with the liquidity grab has been really good on gold too. Now, this is very important, and I can't stress this enough. You have to test it out for yourself. A lot of variables can mess with this, and my results will definitely not be the same as yours. You have to find your own way to use this and learn the pairs that you're using it on. This is what most people don't tell you because it doesn't sell. You can never just find a strategy and copy it and then expect it to work, because trading is an individual game. If I execute the one with the buy limit on gold, I will get a much better result than you. Because I've been trading gold for the past 2 years, my experience with how gold moves is way better than yours. That's why you need to create your way of doing things. And this is the only way that you can actually become a profitable trader. You see, Ronaldo, he doesn't copy Messi. They have both learned to play soccer in their own way. Now, this trade I just showed you is a perfect example. We have the demand zone here. I got in on this rejection right here using what we call a buy limit. Then I got stopped out right here when the market started breaking the structure to the upside, started breaking this candle. Then I got in immediately with something called a buy stop. And then I just rode it to the upside, and I made 25K on this position alone. I lost 6K and then I made 25. Now, doing this and everything in trading for that matter requires risk management. Now, risk management here is everything. I usually, because I like risk a little bit too much, risk the equal amount of me being able to lose 13 times in a row. Keep my risk uniform, and I always risk the same percent over a long period of time. If my strategy gets violated, I'm out. No emotions, no hoping, no praying, no revenge trading. Now, here's the advanced part that most YouTube videos don't tell you. Supply and demand zones aren't just random levels made by trading gods. They represent institutional order flow. When you see a zone getting respected multiple times, it means big money has unfilled orders here. So here's how to rank the zone's strength. How aggressive was the initial move? How many times has it been tested? And how much time has passed after the move? The best zones are the sharp initial moves, fresh zones, an entry right after the move. It could look a little bit like this. Good move, entry, only a couple hours after the move, profit. The second best moves are the ones that are untested after 1 to 2 days. The middle ones can't go untested for long. They're very, very, very good if the price just moves down right here and then continues up, then it's perfect. If the price just moves sideways above the middle zones, well, then they get violated. You can see right here. And then there's not enough buying power in them. And that is too much for these middle ones to handle because they're old and the momentum spikes just right through them, and they're not as attractive as the bottom of the initial moves. Now let's put this together in another way. Right here in this accumulation, or whatever you want to call it, the market gets a big, massive trend to the upside. Now, after a couple months, when the price came back to here, we just barely missed it, and then we started moving up again. Now, this is a demand zone in itself on a higher time frame. Now, you can use this while looking at the picture to figure out where is there a lot of demand in the market. Further down you go, the more demand, because the cheaper the price is. More and more people want to buy this price because it's a better investment. Now, you could just drop down and look at the small picture and wait for the market to break some structure right there, and then you have your initial demand zone right there, the middle demand zone that has not gone a long time, and then when you enter, you can enter right there, put the stop loss below the demand zone, below the recent swing low, whatever you want, risk to reward in everything that you do. This gives the trade more room, but it gives you a worse risk to reward, gives you a higher chance of completion without stop loss, gives you a worse return than if you go like this and you drag it up. I wouldn't, however, recommend to do more than 1 to 1.5 or 1 to 2 when you're trading and you're not profitable yet. Definitely not go for 1 to 5, so 1 to 10 1-to-10s, just become profitable with a 1-to-1 or 1-to-1.5 or even a 1-to-2. The further you stretch your take profits, the more profit you go for in each trade, the lower win rate you're gonna have, the more losses you're gonna have, which means that you're not gonna see many wins, which is gonna take away your motivation of actually becoming profitable because you just don't see the results that you want. Go for something easy, take small steps at a time, and well, yeah, just keep going, man. There's only one way, and that is up. So there's a few common mistakes that you should avoid. The first is trading against the trend. You have to trade demand when you're in an uptrend. You have to trade supply when you're in a downtrend. You should also avoid using poor risk management. It will f up your trading in so many ways if you're using supply demand, if you're using anything for that matter. And another thing is not waiting for your specific confirmation. If your trade don't get activated, if your buy limit don't get activated and that's your rule set and you get FOMO and you want to jump in again, well, don't. You didn't get the confirmation. If you didn't get the liquidity grab, don't jump in. You didn't get the confirmation. If your rules are not met, don't trade. And look, I'm not going to lie to you. This isn't a get-rich-quick scheme. Supply and demand trading requires patience, discipline, and proper risk management. It is the closest thing to reading the market's mind that you'll ever find, and it's simple as So the institutions leave footprints everywhere in the market. You can see how the market is just following supply and demand all the way up. So we have push up, demand zone, push up, demand zone, push up, demand zone, and so on and so on and so on. Then we start moving to the other side. Then we get supply zones that are being taken out. Supply zones all the way down. Then we start getting demand zones all the way up. And we move sideways a little bit down. Guess what? Into demand zone. Right there, the demand zone. Then we move up. Now we know where these footprints are. Now we know how to follow them. The question is, will you put in the work to master this, or will you keep jumping from strategy to strategy? If this video helped you understand a little bit more about how these markets they move, feel free to give this video a thumbs up. Subscribe if you want some more content like this. I just want to give it to you guys raw and direct, no fluff. And drop a comment below with your biggest takeaway. I read every single one, and I also answer all of them. So yeah, Alex here. Hope you enjoyed. I'm out.